Good morning, everyone, and welcome to our Market Performance and Planning Forum for Q1, January 27, 2026. My name is Brenda Marquez. On behalf of the Stakeholder Affairs, we welcome you to today's forum. Today, we have a few housekeeping reminders as this call is being recorded for informational and convenience purposes only. Any related transcription should not be reprinted without the ISO's permission. During this meeting, we are going to be reviewing a lot of topics, so we definitely encourage dialogue, and then we also engage different perspectives. At the same time, please engage in a respectful and professional manner, and also keep comments brief to avoid repeating points already made so we can manage our time effectively. We do have the closed captioning available on the bottom right of your screen, as well as the transparency viewer available for you to see who's on the attendee line. To ask a question during the WebEx, we utilize the raise hand icon located in the middle of your screen. Make sure you select that and you will be added to the question queue. Keep your hand raised, do not unclick it down so we will know who's next. For those who are just dialed in through the phone line, not the WebEx, we'll be using dial *3. As a reminder, when you state a question, we definitely like to hear your name and affiliation before stating a comment. We will make a reminder in case you do forget in stating your full name and affiliation. And when you are unmuted, please hold for a few seconds. The recording may not capture your full name and affiliation when you're unmuted at the time. We do have Tegan, who is our event producer, who will be helping us with today's meeting, and then we will also review a quick overview of the posting of documents. So we did our best on posting the first draft of this document last week, but we were able to make some few updates. So I'll be sending a chat with the most latest link of the poster presentation that is now available under the Market Performance and Planning Forum. As an overview, we did launch our policy initiative stakeholder process overview. This will apply for initiatives within the policy development that later on Becky Robinson will be covering. So this timeline shows how we do within the process of our stakeholders. As an overview, objective of the Market Performance and Planning Forum, we definitely want to focus on implementation planning, discuss external impacts, and also provide policy discussions on stakeholder process and clarify timelines. Today's agenda, we will cover market quality and performance with Guillermo's team on market performance advanced analytics. They will be covering key market outcomes, current market enhancements, and the market issues tracked by ISO. We do have a short-term forecasting topic. New to us is the solar neighborhood that will be covered by the team. And we do have a few, an agenda on slide 8 will be covering the numeric summary of the topics we'll be covering. So we'll share that right now in a moment. Later on, we'll take a lunch break at noon, and then at round 1, we'll return hopefully for the policy update with Becky Robinson on the market policy development. We don't have the slides for the release update at this time, but we do plan to update those around noon, and we will give everyone a heads up on that. And then we'll wrap up with next steps, and that will be it. So we have the market performance and agenda. So as an overview, we'll be going from the executive summary, and then we're going to jump to number 9. So you'll see that change, but we'll return back to energy storage performance in case you're following. But at this time, I would like to introduce Guillermo, our Director for Market Performance and Advanced Analytics, who's also there with his team today. Thank you.
Thank you, Brenda, for the introduction to the session for this morning. Good morning, everybody. Thank you for your time to discuss the market performance for the last few months. Before we go into the matter of the discussion, I want to highlight that you may have noticed that we changed the schedule for the market performance and forum meetings. They tended to be scheduled at the end of each quarter. And eventually we found that that timing was not ideal because it prevents us to be able to come with metrics, trends, analysis that capture the whole quarter. For the case of the last MPPM that was scheduled for December, naturally we wouldn't be able to cover all the analysis through the end of the year. And that was the motivation to reshuffle the schedule. What we are proposing and doing now is having the sessions the month after each calendar quarter is completed. In this case, we are doing this for the end of January, and that gives us the flexibility to be able to put all the material together all the way through the end of the fourth quarter. And in this case, we can report on the whole annual metrics. It is just a little bit of logistic motivation to have better timing with the material that we present. That said, we have a full agenda for today. We have about 11 topics that we want to give you an update. Some of those go through the standard market performance assessment that we do for the functioning of the market, day ahead, real time, congestion revenue right. We also emphasize for this round some metrics regarding the settlements, bit cost recovery, congestion revenue right, real-time congestion offset, and so on. We also have the typical trends of prices and cost, given that we have all the 2025 numbers. Then we are going to move into a couple of topics that are more related to enhancements. And we are going to be talking or briefing you how the enhancement to the market disruption logic has been performing so far after we implemented that at the end of 2025. We are going to jump ahead with the discussion of a new enhancement that we're exploring that is going to be covered by Michael Martin from Operations regarding some enhanced logic for the temporal condition that we call terminal condition. And we are going to elaborate on that. Then we are going to go through the discussion of 5 market issues that we are reporting for transparency purposes. They are a miscellaneous set of items across the market functionality. And then we're going to go through another enhancement related to the management of renewable forecasting, a feature that we call persistency. As usual, we also include at the end of the deck an appendix that contains all the standard metrics that we put in there to keep the tracking of the different aspects of the market. But we do not expect to go explicitly into discussing those metrics in this session. If you have any questions regarding those metrics in the appendix, we are happy to entertain the discussion, and maybe we can take some questions back for further investigation. But the scope is to cover only the first part that is in the section of the market update. And with that, let's move on to the executive summary. If you don't want to go through the 100 pages of the presentation, you can just stay with the high-level summary that we put in the front pages. And this quarter, and I would say in general, this year, 2025, was relatively modest and moderate relative to previous years. And as you are going to see, that materializes in very different metrics that we report. One of the very fascinating topics that we are going to cover today is regarding the performance of storage resources and their impact on the overall market performance. If you have been closely watching the performance of the market in the last 2-3 months, you are going to find that it is a very interesting profile pattern that you are going to see between storage resources and the operation of the system, and we have some good information in that regard. Some bullet points on that is that it is basically 2-3 years since the regulation market has been saturated by storage resources. Effectively, it means that we are procuring most of our requirements for regulation from the same technology, that is storage resources. For the last 2-3 months, the interesting pattern that we're going to discuss further is that storage resources, as expected, are arbitraging energy from midday hours to be able to discharge in the evening. The levels of charging in the middle of the day have reached the point where now the total demand of the system happens to be in the midday hours. Our peak for the day is happening anywhere between 9 a.m. through 2 p.m., rather than the typical profile of peaking in the evening. And another fascinating profile you are going to see is that the storage resources are helping to meet both the morning and the evening peaks. And I have to emphasize this is closely related to the profile that we have for the winter period. we are not talking across the whole year because obviously the conditions for the summer are quite different and the profiles are going to be different. Regarding the storage resources and the implications for settlements, we are tracking this and reporting that most of the Bitcoin recovery, over 96% of that in 2025, were associated with gas resources, as expected, because these are the type of resources that are exposed to the temporal conditions that may drive on economical dispatches, which may result in Bitcoin recovery. And about 3% of the Bitcoin recovery is associated with storage resources. Next slide, please. We have another area that is regarding the market enhancements and the process improvements that we are pursuing on a continuous basis. And one of those, as you are going to see through the specific item down the road in the presentation, is that we continue to press on improving the performance of the market by going after the drivers of the load conformance. We have seen the impact of having a more surgical process for the day-ahead market for the ROC adjustments, and that has resulted in less Bitcoin recovery in the ROC process. We are also pursuing similar enhancements, or at least assessments, of the load conformance for the real time, and we are reporting something very specific that we are doing nowadays for a pilot test and for reducing the use of the load conformance in the real-time market. We have also implemented the enhancement to mitigate for the real-time market disruptions. We have some trends to show that effectively we have very few disruptions moving on after we have implemented this. And obviously there is a seasonality. There are some conditions that move depending on the type of solution we get, but the trends look pretty minor in terms of the volume, the frequency of the disruption that we have seen recently for the real-time market. We are going to go over an enhancement that we are exploring. It's not implemented. It's an exploration phase in which we are right now regarding a logic to better handle the commitment of long-start units, because they pose some challenges when it comes to the end of the commitment period. That is what we call the terminal condition. And we also have another enhancement that we're going to discuss at the end of the deck regarding an enhancement for persistency. Persistency is just a type of forecasting that we do in the real time, and it's specific to solar resources. Next slide, please. We also report on 5 different market issues that we have been tracking. Some of those are completed in the assessment and the conclusions of what we can do. One of those is the fact that we were reporting incorrectly the designation of competitiveness for some transmission constraints. And that was very specific to some intervals of the 5-minute market. I recall it was for intervals 11 and 12. That issue has been addressed. We have done the assessment of the implications and the potential impacts of that into the market solution. And at this point, we are not taking any corrective actions retrospectively. We also have an issue that was reported actually by a participant regarding the price formation due to the congestion on a nomogram and how that congestion component was reflected in the price for an intertie location. This is the price that we call the SPTI combination. That is an association of the specific scheduling point and a given intertie transaction. We identify the issue. We have improved the process. Given the timing of that issue that was beyond the window of the price correction, we could not correct that price. We also are proposing some BPM changes to have better expectations for participants of how they have to be bidding when we have resources related to the off-grid charging indicator. We also have an instance of default energy bids that were used incorrectly for certain periods in the market. we have some assessment of the impact of that and the action that we are taking to mitigate. And the last piece is a data quality issue that impacts the forecasting, because the telemetry value coming as an input to the forecasting was in error. And it is important to recognize that as the quality of the data is impacted, the potential implications for the accuracy of the forecast may be compromised. And we will elaborate on each of those market issues as we go through the topics. I think this is what covers the executive summary. Let's pause. Well, let's move to the next slide, just in case I'm missing something, Brenda. Okay, we're going to jump, just because of some timing complications that we have this morning, we're going to jump to a topic that is in the middle of the presentation regarding the terminal condition. Before we pass it to Michael, Brenda, let's pause and see if we have any comments or questions so far.
So let's see if there's any questions. I don't see any, but if folks do, we'll keep an eye on. Thank you. Go ahead, Mike.
Okay, thanks, Guillermo, for allowing me to jump the line here. I'm Michael Martin, Principal in System Operations. I'm going to share with you this RTPD enhancement for consideration of what we call the terminal condition. It's not as bad as it sounds. So what is it? It is a specific, and dare I say, very rare scenario where the minimum downtime for a long start resource, and a long start resource is defined as a resource with a cycle time of greater than 255 minutes, where the day-ahead awards have a gap, and that's a gap in the middle of the day, for example, from a shutdown to a subsequent startup, where that gap absolutely equals their minimum downtime. So let me try and describe it with this print screen, and let's only focus on the top line. And what you're looking at here is, this is a list of generators on the far left, and the names and the numbers don't really matter here. The red and the green are hours. Each column are hours of a day, 24 hours, and the red and the green together are the gap between a shutdown and a subsequent startup later in the day. The green is equal to that specific resource's minimum downtime, and the red covers the rest of the time. Actually, in this case, this is not a terminal condition, where an actual terminal condition would be just green. The minimum downtime exactly equals the gap between the day-ahead schedules. So should that have happened, let's say the red wasn't there, then let's go to the second bullet. Should in this case, RTD or RTPD keep the resource on just for one interval, then that is the terminal condition, because then we have to keep the resource on for the rest of the day. In this case, 4 more hours. And that's why we get to the words terminal condition. The market cannot do anything more than keep it on. Before I go to the next slide, any questions on the terminal condition?
We do have a question from Kathleen Colbert. Go ahead and Kathleen, introduce yourself.
Great, thanks. Kathleen Colbert from Vistra. Yeah, just a clarifying question, Michael. So when I think of the scenario that you're starting to lay out, what I think of is the fact that in the past we've used bridging to kind of keep some of the MSGs on through their minimum downtimes and kind of kept them operating and bridge them between days. Is that, can you just clarify for me, am I on this right page of where you're going, or what's the difference? Because I'm getting just a little confused, because that's where my brain went.
Sure. Bridging is, and we'll talk about essentially that as an option. The approach here is this is a day-ahead result, and should everything play out as day-ahead was executed on, if everything's perfect, then we really shouldn't need to bridge.
Bridge. Okay.
Yeah.
Okay, great. Thank you.
Next, we do have Alva. Go ahead, Alva. Introduce yourself.
Can you hear me? Am I audible? Is Alva Svoboda, PG&E? Yeah, I wanted to just verify this again. This is more just clarification. So the potential savings from not shutting down would be to avoid a start, but that would be set against the uneconomic operations of the unit during that green period, right? That's really what we're looking at here.
Right, and we'll discuss this in the next slide. What you're getting to is the resource might or would have to stay on across potentially uneconomic time. They weren't expecting to stay on, let's say, for a number of hours. So it's a surprise to them, and the settlement might not be what they were expecting either. So operationally, we might not have really needed them online through that entire longer period also. So then the market is having to re-optimize with this resource.
Right, right. But they would have had bids in place for the period anyway, so they would have been, in some sense, they would have been ready for whatever HISO decided to do with them.
Oh, absolutely. You know, as I suppose any resource is, especially that RA, is always ready. But
right. Going
off of the day-ahead result being, you know, the best right. indication we had, then we would expect we would be okay, unless
great.
Conditions change.
Thank you.
So let's go to the next slide, and I think some of the questions touched upon this. So again, this is only for, I want to make this clear, only for these resources and only when it's this exact scenario, when the min time matches their gap between day-ahead awards. It is not for everyone else. When that scenario happens, that shutdown that occurred at that first hour of the green now will be considered binding. So the market will say, this is a binding shutdown, and will honor that and will not keep it on through the normal optimization that occurs in RTD and RTPD. The terminal condition code, this is for the operator, will display that this, you know, display for operator awareness, this is a terminal condition, this is why this is a binding shutdown. And should the dispatcher need it on, then would have to do an exceptional dispatch. So that's always available, but would have to do it. The market will not keep the resource on just for an interval, for an economic single interval reason. Again, the third bullet noting again that this is only for this specific scenario, and typical day-ahead long start awards are treated the same as they are today. And then I think I have one more slide which kind of summarizes the benefits of this. It eliminates the terminal condition, this unintended situation of the market keeping a resource on for potentially just one interval, reduces concerns about that additional dispatching through the entire day and potential disputes. We're giving operators awareness. This is for CAISO operators and for future EDAM entities, because these are day-ahead awards. And the potential or ability to override should the resource need to be kept online. So the next step is we're going to initiate a BPM change and put this through the BPM process.
We do have a question. Kelly Wells, go ahead, introduce yourself.
PTF. I just have a quick clarifying question on this. So I know the proposal or the change is that the RTPD shutdown instruction will be binding. And you walked through the example where the RTD kept it on for one more interval. Does this ever happen where maybe the RTPD market keeps it on for another 15-minute interval and then you kind of have the same situation? Or is this predominantly you guys seeing this in the RTD? And that's why you're now enhancing it to where the RTPD shutdown instruction is binding.
It's really only RTPD that keeps it on. RTPD defines the online offline status. So yeah.
So then if RTPD issues a shutdown instruction, that becomes binding. And if the shutdown instruction still has the minimum downtime now violating relative to when the day ahead schedule starts up, then, and I'm just to make sure I understand this. So the only way they can meet that day ahead schedule is if market operators ED them on, or am I missing something here?
No,
I just want to make sure I understand the scenario.
Yeah.
Okay.
Yeah. Yeah.
Okay.
Exactly.
So then they'll miss their day. So the choice is the operators issue them an ED so that they can keep with their day ahead schedule later in the day, or they don't issue an ED, they shut down, and then do they receive another binding, then they wait for RTPD to issue them another binding startup instruction, which may or may not be the same as its day ahead?
So your scenario was, should the operator decide to keep them online, they have to submit an exceptional dispatch to keep them online, and they would then be online for the entire period.
Yes.
To make it, yeah.
But if they don't get an ED, they obviously then won't be able to meet their day ahead schedule later in the day. So are those basically kind of the two scenarios? They either get an ED and they can meet their day ahead, or they don't get an ED and then they wait for RTPD to maybe issue them another startup instruction. But I don't think they ever would, right? Because they're a long start resource.
The scenario is, right, if they don't do an exceptional dispatch, RTPD will shut them down. That will be a binding shutdown to honor that. It's looking ahead saying, I need to honor that minimum downtime so that it can come back on later in the day.
Okay, I guess that's what I'm trying to figure out. It will be able to possibly come back on later than the day, but it won't be able to meet its day ahead schedule unless they got an ED.
Yeah, let me clarify, because I think we need to distinguish between the current practice and the enhanced practice that we want to have. The current practice has a schedule from the day ahead that is expecting the resource to shut down at certain time to be able to meet its minimum downtime, to be able to come back later online to meet the next day ahead at work. As of now, the current practice is that we still leave that optimization to the real time to decide whether it's going to shut down that resource exactly at the projected time of the day ahead, or potentially can expand it for subsequent intervals. If it happens that the cycling of the unit is precisely meeting the minimum downtime, it has no margin for delaying any shutdown. If the real time determines that it needs the unit for an extra 15 minutes, that means the unit is going to stay online for an extra 15 minutes. But now, if it shuts down that resource, it will not be able to make the next startup time from the day-ahead market. So the current practice or the current optimization is that the unit now has to remain online for the remainder of the minimum downtime in order to achieve the day-ahead schedule. That is the current logic that we have. What we're saying is that, well, real time is making an assessment based on the conditions of the economics of that 15-minute market. It doesn't have the view for the whole horizon in the future. So most likely, we could still be okay to not have that unit extended for an extra 15 minutes. What we want to do now as an enhancement is to ensure that when there is this precise cycling that is based on the minimum downtime precisely, the real time will not be re-optimizing the shutdown from the day ahead. It's going to honor the shutdown of the day ahead precisely at that time, and it's going to shut down the unit. With that, the unit shutdowns as expected from the day ahead schedule, and is going to start up on time as projected for the day ahead for the next cycle. Now, the caveat, as Michael was indicating, is if the operator happens to make an assessment that, by the way, we actually need that unit for the upcoming time, the only way now to ensure that the unit remains online is to issue an exceptional dispatch. That would be the future practice.
Okay, that helped a
Does
lot.
that-
I think I think the detail I was missing is that it would honor, it sounded like you said it would honor its day ahead shutdown instruction in the RTPD. So then my scenario wouldn't actually happen unless they get an ED. So, okay, that helped a lot. Thank you, Guillermo.
Thank you, Ken.
Is that a new hand, Kathleen?
Yes, it is. Thank you. Kathleen from Vistra. Yeah, no, this is all super helpful. I think I'm also getting closer to comprehending. I'll speak for myself. I know some more examples would be useful if you could try to consider that. So, you know, as an operator of a large gas asset, I'm just trying to, I think I have a couple of questions, but I know that there's a lot on the agenda today, so I'm completely open to you saying maybe we should sidebar this and circle up for a more in-depth conversation somewhere else. But one of my things that I'm just trying to process is, you know, I do think about the MSG operations like being informed depending on what the start of the transition time, or like the, you know, from various different elements, not just the min downtime, and how STUC is informing it, not just RTPD. And I am struggling to make sure I'm understanding if when you say RTPD, if we're really only talking about RTPD, where like the technical changes, you now want to lock, like similarly to RTD, where the commitment status is locked at the binary variable. It's either 0 or 1, depending whatever RTPD set. If you're essentially saying you just want to make that thing change to RTPD based on whatever, and I assume it would be the STUC result was, if STUC could have changed the commitment status, or it would have been day ahead. And it just, this extra clarity as someone who operates an MSG would be really helpful.
Yeah, let me answer that, Kathleen. Hopefully that provides more clarity.
Okay, yeah.
You are right that we have the 15-minute market, RTPD, and we also have the stock market that goes into 18 intervals. The logic that we have for commitments in the real-time market is that we issue only the last binding instruction. You may have, given the timing for the commitments, many opportunities to start up or shut down a resource. We will not issue that instruction until the last opportunity. That means there is no further opportunity in the real-time market to issue that instruction. Now, for startups, it's more complicated because you have to see how long it takes to start up and make sure that you comply with the temporal constraint. For the shutdown, actually, it's pretty straight because it can be shut down right away in the last RTPD run. That means a stock is going to be assessing the commitment of all the units and is going to assess whether we need to shut down certain resources. That instruction from a stock is what we call advisory, because it doesn't need to be issued 2 hours in advance, 3 hours in advance, because all what the time is needed to shut down a resource is 15 minutes. So that is the reason that we move the instructions from a stock market to the RTPD market, and when it's the last time that is feasible, then the RTPD is going to issue what becomes the final binding shutdown instruction. So everything is synchronized. Eventually, what matters is the instruction from RTPD for the shutdown.
Mhm. And what I hear you saying, Guillermo, thank you so much for this. What I hear you saying is that the request, like the improvement you'd like to see is when you send that binding shutdown instruction to make that unit unavailable for an incremental commitment if the market horizon could have committed it.
Right. We don't want to extend that commitment of the unit for an additional interval or any number of intervals, because it has the consequence that now we are going to force the unit to stay online until it reaches the next cycle of the startup of the day ahead.
Mm-hmm. Yeah, the one thing that I'm still a little confused about, and happy to see that, Mike, but is whether what we're talking about is once kind of RTPD like affirms what is the economic binding shutdown, it gets kind of locked for the remainder of the at that point, or if what you're thinking is that you want to respect the day ahead shutdown instruction. So in the interval where the day ahead shutdown instruction would have occurred, you essentially are forcing that result in the real-time market. That's the piece that I'm confused about, that I hear both sort of in your explanation, and would appreciate some extra clarity on that at some point in time. Thank you.
Thank you, Kathleen. And you're right. Basically, this enhancement is ensuring that we comply with the day-ahead commitment schedule so that it can really have the opportunity to cycle for the next round.
Okay, that's super helpful. And could you clarify for one more time which, and you said that it doesn't apply to all, it's only, is it extremely long starts, or is it based on a definition of if your minimum downtime is a certain length? Can you just clarify that one more time? Thank you, I do appreciate it as this impacts actual assets. Thanks.
And we'll, as we mentioned here, and you mentioned more examples and wording, in the BPM process, we'll put language out there, and please take a look at it. It is the definition of cycle time of 255 minutes or greater with day-ahead awards. Oh, another question from Mark?
Yes, Mark, let's go ahead. I think Kathleen doesn't have a question, so she lowered it, I believe. Go ahead, Mark. Smith?
It's Mark. Can you hear me?
Yes.
Okay, good. Thank you. Thanks for this, folks. I just want to try to simplify this as best I can. It sounds to me like if the min off time is a binding constraint, you will order a mandatory shutdown in order to meet the next day ahead schedule. So you will prefer or use the day ahead commitment as the driving force here, even if the unit remains economic in the real-time market. Is that right?
Yes, that is correct. And again, the reason why is to honor that min downtime and future schedule, which is a consideration also that is noted. I didn't note it in these slides in the tariff that this consideration is, can be done and is a valid input.
Okay, but if the minimum downtime constraint is not binding, the unit will be held on with RTPD or real-time dispatch signals if it's economic?
Correct. So that's where I tried to make the point that it's only in that scenario where that gap matches exactly.
Okay, and how often does that happen?
I tried to say it's pretty rare. Even in my example, I didn't even find one. There's only, you have to line up the handful of, in the ISO BA, 50, 70 resources that qualify, and the exact scenario where that gap in the day ahead matches the min downtime. You can see that this doesn't happen very often. However, when it does, it's super obvious what the problem was. And so it seems like something that we have a good fix here for. So that's why we'd like to share it here.
Yeah, but it might be, it might happen more often when a unit is held on by real-time dispatch, and in some subsequent interval, it then envisions its minimum downtime constraint, or its minimum downtime constraint becomes binding. I can clearly see that happening. If a unit is held on past midnight, for instance, until 1 a.m. In the real-time market, and then it hits its minimum downtime constraint, is the unit going to be shut down then?
I didn't understand the scenario.
Okay. So, yeah, maybe we should. Yeah. So this is not a day ahead. You know, you're not never mind. Let's take it offline. I think this would be really helpful just to sit down and walk through a couple of concrete examples of units being either shut down or held on.
Okay, and as noted, this will go through the BPM process. We have 2 months of BPM, comment period. This will not go in as an emergency change, the normal process of 2 months. So join us there.
All right, thank you.
Thank you, Michael. I think there's no more questions at this time.
Okay, I'll take it from here. This is energy storage performance section. This Quinn market.
Oh, sorry. Just making. Can you put the audio more closer to you?
Yeah. Let's try
Thank
again.
you.
This is Quinn market analysis. Okay. Next slide, please. In this section, we'll go over some storage resource performance over a period of time, some longer trends, some specific trends in the winter season. And here is the summary. Storage resources, as we have seen, have saturated the regulation market. And we'll see a small section where Guillermo will illustrate how the charging of storage resources in midday hours have led load to peak earlier in the day. And we will see that storage resources are dispatched to meet both morning and evening peaks. Next slide, please. We start by looking at this long-term trend. This has been one of the storage section standard. Now, on this chart, we're looking at the proportion of storage resources in regulation up requirement within the day-ahead market. So data goes back to January 2023. We're looking at monthly distributions as box plot, vertical box plot. The y-axis is the share of battery in reg up requirement in percentage on the left. And we have the average reg up requirement in megawatt on the second axis as reference. Here we can see that storage have been saturated the reg up. Well, we said regulation both directions. Actually, here is the reg up direction. We're looking at percentages, median percentages around 100%, and some of the outliers goes up to 200, 300, and so on. By the way, the percentage share, I forgot about that. Percentage share definition. So this percentage share is defined as total market awards from LESR divided by total market requirement for that commodity. Next slide, please. So this is the same chart on the down direction. Here is the percentage share of battery resources in regulation down requirement, also in day-ahead market. We see that storage have been consistently holding a substantial share in regulation down as well, and same period, January 2023 through December 2025. Next slide, please. We also track the storage state of charge trend. This is storage resources state of charge distributions by hour, and in Q4 2025, we see that we usually see a lower percentage of state of charge early hours of the day. It reaches the minimum around morning peak hours, hours ending 8 and 9, and then we start charging the battery resources, so the state of charge goes up until hour ending 16, 17. That's when usually state of charge peak on the system level, and then goes down from there to meet the evening peak hours. Next slide, please. Here is another standard trend, real-time state of charge for battery resources. Usually we'll look at hours of the day for state of charge status, and this is 6-month trend, so by month, by hour. We see that we're, again, reaching the peak state of charge around hours ending 16, 17-ish for all months of the year, displaying on this chart. And going into December, we do see more variation so that the outliers are more substantial. Next slide, please. Here is the megawatt portfolio. So this is real-time energy schedule from RTD. We see that battery resources are charging in the midday hours, usually during the solar hours, where we see the nice valley down there, and then discharging during the net load peak. So that's the highlighted hours, evening peak hours. The shape remains the same for all 6 months of the year, and again, we see more outliers in December. Next slide, please. So we've seen how storage resources saturated reg up and reg down. Here is an hourly average by month. So real-time storage AS words, we have reg up and reg down from the past, and then we see that storage resources are procuring more spin and non-spin as well. That's the yellow and blue. So really, storage are supporting all AS commodities at this point. Next slide, please. We look at the battery bidding capacity as well. Here is the second half of 2025 bidding capacity in the day-ahead market. Each tiny bar showing there is the daily average. Kind of shows how the bidding capacity evolve over time. The second half of the year, we can see that there is a consistent increase in battery storage bidding capacity. There is a bit of a dent around November-ish. That's the outage we've seen in the market. And the bidding capacity are categorized by price buckets. So if you're interested, the price buckets are down there. Next slide, please. Similarly, we look at the bidding capacity for batteries in the real-time market. The trend largely aligned with the day-ahead trend, but you see more ups and downs in the real-time chart to see how battery resources are responding to the real-time situations, how some colors are sticking up and the others are not. But we still see this consistent increase over the second half of 2025. We see a hand. We can take the question now.
Okay, Alva, I did get a question from you on chat. Would you like to state on that one, just in case?
Yeah, I had two brief questions, Kun. One was the one I asked in chat is how is it possible to get more than 100% of the requirement? Are you just taking more under some circumstances than the regulation requirement, and are you paying for that?
Right, so the 100% on the first chart, that is the storage reg up awards divided by reg up requirement rate. So on the upside, AS procurement, we have this cascading. That means we procure a higher quality product to sometimes meet the lower quality product requirement. So page 16, Brenda, yes, this one. Right, this one. And that's why we see over 100% on this chart, because the denominator here is reg up requirement alone, and we are procuring a lot of these numbers, reg up numbers for spin and non-spin.
Okay, that's interesting to think about that. And that's just something to think about. So the other one I was interested in your perhaps hot take on, or maybe just to provide some information in the future, is during the storms in December, did the operating pattern of the batteries that are in the energy market, did that operating pattern change, or did they just remain the same, essentially, charging to meet the net peaks, and just expecting a higher arbitrage, sort of indicated by the real-time bids as well as the day-ahead bids that they were expecting a higher arbitrage. I'm just curious whether the operating pattern basically stayed the same, or whether any batteries pulled out of the market because they couldn't get charged because of the lack of solar.
Yeah, so we actually have one example at the end of the section to illustrate one scenario. So stay tuned.
Perfect. Thank you.
Thank you. All right, let's move. Yes, this one. So here is hourly breakdown of the same data. We have month by hour of the battery bidding capacity for the second half of 2025. We see that battery fleet usually bidding to charge during the solar hours and bidding to discharge during the afternoon peak hours. This is a day-ahead portfolio. Next slide, please. And here is a real-time portfolio of the same period. We see that the real-time bids generally align with the day-ahead bid set, but we see a stronger positioning, meaning they're bidding in higher prices to discharge during the midday hours, and they're bidding in lower prices to discharge over the net peak, evening peak hours. Next slide, please. Okay, here I'll pass it to Guillermo to talk about the longer trend on the load portfolio, how batteries are changing that.
Thank you, Quinn. And this may answer in part Alba's question regarding the patterns that we have observed for the recent months with storage resources. And the idea here is to really compare the evolution of the profile of storage resources over the last 4 years. This is a representative sample for 4 months, and they are relevant because of the time of the year we are assessing the market performance. It is effectively the winter time frame. So we have the matrix showing every quarter, every month of the winter time frame from November through February, organized by the different years. Each year is represented with one line with different colors. The most recent time is darker blue. Not surprising, this is quite a common knowledge that we have large penetration of storage resources over the last 3-4 years. And this trend is a testament to that evolution. We can see with the very light colors as early as 2022 that we do have the profile of charging in the midday hours and discharging in the evening peak time frame, and to some extent also charging in the very early hours of the day, very marginally. There are resources that they still have some state of charge from the previous cycle, from the previous day, and mostly that is used to support the morning peak around hour ending 7, 8. As we progress over the years, we can see that the darker color, specifically for 2025, has gone pretty deep in the midday hours. We have reached effectively the 6,000 megawatts as early as this December 2025. And that means having that much charge in the middle of the day simply means that there are plenty of opportunities to discharge for later in the day and be able to provide a meaningful capacity to meet the evening peak. Consequently, we can see also that the level of discharge, mainly for the evening peaks, have increased proportionally to the profile that we have for the charging in the middle of the day. That is a very rational harder to see because obviously it's reflecting the arbitrage opportunities for storage resources where they can maximize the plenty amount of solar production that is in the middle of the day with potentially the lowest price that could be observed in the day, sometimes even negative prices, to charge as much as possible to then be available for the evening or peak or even the afternoon ramping period. It is the ideal profile that we expect to see to reflect the arbitrage that may happen. Next slide, please. Given that substantial increase in the level of charging and discharging for storage resources, there is now an aftermath in the operation of the system. We have different definitions of load, demand in our system. At the end of the day, the total demand that the system has to balance with supply includes the conforming load, the end user, the portion that is forecasted, but also the obligation imposed by dispatching pump storages, and also the obligation from charging storage resources, because that simply takes supply to charge the storage. All this together is what becomes the total demand for the system to balance. And we naturally track the profile of that total demand, including when and what peak that demand shows. This graph is trying to portray the evolution of the trend of when the system is peaking. And we can start as a reference for the last 4 years, going back to 2022 up to present time, basically. And we have a dot to represent the peak for each day, for every day of the 4 year reported. Now, the y-axis stands for the time of the day, and is subset only to reflect 6 in the morning to 10 p.m. because most likely we're going to peak somewhere in there. No value to add the other hours unless we are going to be peaking at 1 in the morning. But this gives you the sense of when in the day the CAISO balancing area is peaking. There is a cluster of dots in the range of 6 p.m. to 9 p.m. You can see we start as early as 6 p.m. in the beginning of the year, somewhere in January. Then as we start going deeper into the springtime transition to the summer, we are going to have longer days, and the peak is going to be observed later in the day, as late as almost 9 p.m. That is somewhere in May, June, when we have these long daylight conditions. And then as we pass the summer conditions, we start observing the peaks to be earlier in the day. Typically, anywhere between September through December, you start to see the daily peaks to be anywhere between 6 p.m., 8 p.m. That is the upper part of the trend. The interesting part here now with the incorporation of storage resources is the dots that are in the lower range, anywhere between 2 p.m. and 6 a.m. What we have seen, if we put the reference for, let's say, 2022, we may have maybe 2-3 days where we actually peak early in the day. That most likely is the natural load that was peaking in our end in 7, 8, just in the winter time frame. As we progress with integration of the storage resources through the recent years, you can see that 2 things happen. One, we have more instances of peaks happening in the morning. And the second part is when in the day they are evolving too, because naturally you start with those that are just reflecting the peak of the natural load, no pumps, no storage. And then towards the end of 2025, now we have these peaking conditions happening later in the early part of the day, anywhere between 10 a.m. to, in some cases, 2 p.m. These are quite revealing that the peak of the day now is observed for the winter time frame in the middle of the day. That happens to be when we have the maximum level of production from solar, and it happens to be the time when we have the maximum level of charging from storage resources. So all this comes together to have a very interesting load profile once you incorporate the effect of the storage resources. We can move to the next slide, please. Okay, Brenda, do we have a question or a comment that we can take on now?
Yes, it was on slide 27. It's asking Alan if it reflects the peak of load plus pumped hydro plus storage charging.
Yes, it's the total demand.
Okay, does the total peak also include exports?
No, it doesn't include exports.
Thank you.
This comparison shows two profiles. One is the load obligation of the balancing area when we don't account for the component of the storage charging, and that is the darker blue line. Once we incorporate the load obligation to serve the batteries when charging, that becomes the dotted line that is more evident at the top of the blue curve in the middle of the day. So you see you overimpose the trend in blue with the dotted line, you can see that the peak of the day, very interesting for 2025, for this sample period that we are showing at the end of November, happens to be anywhere between 9 a.m. through maybe 12 p.m. And it is not just one interval where we peak at that level in that time of the day. It's a sustained peak that goes for over 2 hours. That is a very recent profile that we see given the conditions that come to play together. One is obviously it is the time of the year where we have moderate levels of demand. We are in the winter, we peak in the summer, our demands typically are below 30,000 megawatts. And now we have more than 15,000 megawatts of storage resources that are positioned to charge in the middle of the day to absorb all the available supply that could be at that time of the day. It is a perfect combination of these conditions to have this type of outcome and evolution of the load for the CAISO system. Next slide, please. And you forget about what component is included, and you see the total demand of the CAISO area, that is conforming load plus pump plus storage. This is a profile that we have seen for the load evolving over the last 4 years. Lighter blue reflects older times, darker blue reflects more recent time, and you can see that the middle of the day demand level just keeps increasing. The belly of the duck is just evolving to be something else, to the point where you see December, that belly of the duck is gone. And this is actually the gross load. This is not even the net load. So at this point, you can see that the profile of the total demand has evolved significantly to the standard profile that we used to have prior to the integration of storage resources. Next slide, please. And this is just to give you a reference how frequently this is happening. This is a correlation between the morning maximum value, where we ideally capture the evening peak, versus the morning maximum value, where we are going to capture also the morning peak. And there is a line at 45 degrees that is in gray, just to indicate that any dot, and that each dot is basically a peak level for each day. Every dot that is above that 45-degree line means that the evening peak is greater than the morning peak. And consequently, any dot that is below that 45-degree line indicates that the actual peak of the day is happening in the morning. And the lighter the blue, the most recent the time is, and you can see that we have more and more dots clustered below the 45-degree line, indicating that, well, we actually have more and more days where the peak actually happens in the morning. That is the progression, the evolution that we see for the peaking of the system. Next slide, please. Last one. This is just a way to accommodate the different variables here. Let me start with the trend that is plot with the dark blue line. That is the standard load of the CAISO balancing area. The portion in reddish, dark red, is the contribution of storage resources. Whether they are charging, that is going to be additional load, is going to be above the profile of the demand, or whether they are discharging, they are providing supply, they are effectively reducing the load obligation because they are supplying that portion of the load. Therefore, it goes below the shape of the blue line that is the standard demand. What comes out of that combination is the line in yellow. That is the net effect after you take into account the contribution of storage resources, increasing the demand in the middle of the day, haircutting, shaving the peak load when they supply. And the profile that you see in the yellow line is effectively the profile of the demand that is met with non-storage resources. There are some factors to consider here. First one is that it flattens the load profile that has to be met with conventional resources, and that simply means it relieves pressure on the ramping needs from conventional resources because now you have a flatter load profile. Next slide.
We did get a quick question, Guillermo, asking if the CAISO can confirm the 5-minute data posted on today's Outlook. Does that not include the storage charging?
Sorry, can you repeat the question?
Can you confirm the 5-minute data that's posted on today's Outlook does not include storage charging?
For what variable is the question about? Is for the variable of the demand, I guess? Yeah, that wouldn't include that, but they can refer to the information that is actually on OASIS.
Okay, Amber has her hand. Let's see if she can.
There is in the information, if you click on the information tab, it does tell you what is not included on today's Outlook, but it doesn't include the market participating discretionary pumps, and then it doesn't include market participating battery charging.
Thank you, Amber. And we do have a question, Guillermo. It might be for you, Kathleen Colbert. Go ahead.
Quick question, Kathleen Vistra. Just wanted to confirm, appreciate the clarity on your charts and you're walking through don't include exports, but can you confirm if they include net EIM transfers? Like if I'm looking at blue, load not met by batteries, could it be load met by transfer or no?
No, it doesn't include transfers.
Okay, great, thanks.
You're welcome. Okay, let's move on to the next slide then, Brenda. Now, from the bigger picture, let's move into a more narrow target of performance for storage resources. And December, given all the variations of the conditions that we experience in the system in terms of the demand, the renewable resources, and the storage, you come up with some very interesting profiles. We picked this 3-day profile because it's pretty revealing how storage resources are being used to balance the system in very creative ways that the market optimization finds the most efficient way to do it. This is a profile of the supply that we have for this 3-day, December 23, 4th, and 5th. And I would refer to the trend in green, that is the renewable contribution, the VR production. And you can see through these 3 days, we have quite a different profile of generation from VRs. Effectively, the 24th is a day where we have pretty modest contribution of VR resources. If you refer to the 25th, it's about a half at some point of what we have produced on the 24th. And that's going to have implications because that means lacking that amount of supply that typically comes with relatively low prices, it will require other type of generation to pick up the difference because the total demand may not change dramatically. So the profile of the generation is the one that is going to change. In this case, we're going to have more imports, we're going to have more gas resources picking up the gap. What does that mean for storage resources? Well, it's also going to impact because it's not going to be displacing per se generation from storage resources because it's the middle of the day, but it's going to substantially impact how we are going to be charging storage resources given the fact that we don't have that much supply in excess in the middle of the day. Next slide, please. This is the profile of the storage resources. Charging negative values, discharging positive values. The trend in dark blue is the net between charge and discharge. And then we also have the dispatch, the state of charge in the dotted line associated with the second axis on the right. And you can see the profile for the 24th is not exactly the typical profile that we tend to observe, which is we charge storage resources heavily in the middle of the day so they can ramp up and be able to provide that supply for the evening ramping conditions of the day. The 24th was a significant departure in the profile of the storage resources because the supply was not there. Correspondingly, the prices are going to reflect some other dynamic. Prices are going to be higher, and therefore may not be that economic to start charging the batteries the same way that we typically do. And indeed, given the prices that we observed in the middle of the day for the 24th, it was actually economic for storage resources to discharge. So one can wonder how that would position the system for later in the day where we have to meet the evening peak. In this case, the batteries were dispatched in the middle of the day, discharging to handle the volatile conditions that we have in the system, and given the price that were much higher, they were in merit to be actually charging for this specific time of the day. The other condition that you are going to observe is that early in the day, they were actually charging quite fairly to be able to have some available energy for the morning peak, and that continues through the middle of the day. Next slide, please. This is a profile that just overimposes how the storage resources were bidding relative to the real-time schedule, how we dispatch them, and what the system price was, because all these come together. They are going to be dispatched based on merit, and they are going to be dispatched on merit, but subject to the clearing prices that we have in the system based on the supply that is available. And you can compare, for instance, the trend of the red line that are the prices. The prices happen to be actually quite positive in the range of $40 in the middle of the day, and that is when they are going to be in merit to be dispatched. Next slide. And this is just a comparison, just to have the reference of how dynamically storage resources may be reacting to evolving conditions. They have a specific positioning of their resources in the day-ahead market. One day later, when we are actually operating the trading day, there may be newest information, most recent information of the evolving conditions of the supply, and therefore storage resources, like any other resource, have the ability to adjust their bids in the real time. We do see some movement from the day ahead to the real time, and I would say that is a positive thing because it means that participants are internalizing, adapting their bidding conditions to position resources based on the potentially most recent information they have available. Next slide. And I think that's all what we have for storage resources. Let me pause before we move to load conformance. Do we have any follow-ups or additional questions?
Kathleen Colbert, your line will be unmuted. Go ahead.
No, great. Really appreciate it, Guillermo. Kathleen Distra. This is fascinating, and I really appreciate the time you took. What would also, as like a follow-on, another layer to this that I would find informative is to look at kind of how the LEAM operated during the day as well, just to see if there are any regional. I don't remember exactly the day of the 24th, so but just to kind of look how the LEAM itself was interacting with these trends, I think would help understand the real-time market solutions kind of more broadly as well. So if you could consider just expanding on this and add kind of the LEAM viewpoint, I'd appreciate it.
Thank you for the suggestion, Kathleen. Yes, we can consider that for future sessions.
Alva asked if there's any information whether hybrids operated similar to standalone storage.
That's a very good point. We didn't put the material together. We do have the visibility. We will try to bring that in any next opportunity.
I don't see any questions. He says thank you.
Okay, let's move on to the next topic, that is load conformance. This is very straight item just for an update. We can go through the material, Brenda. We have discussed this widely in previous sessions. And you know that load conformance is a practice that is applicable to the CAISO balancing area and also in some other areas of the Western Energy Imbalance Market. We have, over the years, pursued different process improvements and try to tackle the drivers that are driving the use of the load conformance. We have that load conformance applied to both day ahead and real time. In the day ahead, we call it ROC adjustments. In the real time, it's just load conformance. We are now operating in a mode in the day ahead market where it's pretty stable. We haven't made any significant changes to the process and practice that we currently have. And at the same time, we continue to keep the focus on the real time. For this update, we are showing that we do have an update regarding the efforts that we have taken to try to improve the guidance for load conformance in the real time. We have run a couple of pilot tests in recent years, and right now we're going through one more trial that started in December and continues as of now. And we want to show you how that is going on so far. Next slide, please. This is the profile for the day-ahead ROC conformance over the last 4 years. And we have discussed as we have made changes to the process. And as of now, it's stable. It's the same process that we have in place basically for over a year. What is going to happen is that naturally you're going to see more utilization of the ROC adjustment, typically when we have higher load conditions. And that is, generally speaking, during the summer timeframes. Anywhere between May and September is when we tend to have higher requirements because the process is predicated on the demand level. As we get out of the summer conditions, the utilization of the ROC adjustment diminishes greatly to the point that there could be periods where we have no ROC adjustments. And that is just a good reflection of a sustainable practice that we have so far. Next slide, please. And that is going to materialize in different ways of the market performance, and one of those is the implied bid cost recovery, because when we put ROC adjustments, eventually we may influence the commitments that we have in the day-ahead market, and that may consequently reflect on economical dispatches for those resources that were committed in the ROC process. And once we go into the real time, they may settle based on economic prices. When we go through the bid cost recovery process, we quantify and subset the bid cost recovery by the source of the recovery. And the portion here highlighted for the ROC process has been the focus of our improvement in the process to ensure that we are more reasonable in the range of the ROC adjustment that we have used because it does impact the bid cost recovery for the ROC process. If we take as a reference what we observed back in the summer 2023, we have remained stable in lower levels of bid cost recovery for the ROC process after we have implemented these process improvements. Next slide, please. The bid cost recovery remains relatively low for 2025. It's pretty comparable to 2024 and substantially lower than 2023. And obviously, there are many factors at play. One of those has to do with the loading conditions per se, when we have to influence the commitments that we have in the ROC process. As you can see, there is a significant difference between 2023 and the subsequent years. Next slide, please. And this is a snapshot for the real time. And we have shown this in the past, maybe too small to distinguish or appreciate a trend, but if you zoom in, that is the attempt of the small plot in the upper part for just showing the most recent months. What you can see is that the average load conformance that we have in the hour-ahead scheduling process, the HAS process, has been reduced significantly. There are periods of time where we have basically no load conformance applied to the HAS process for the entire day. There are some days, like 2 days ago, the January 25th, where we have on average a load conformance for the day of 158 megawatts. This is an attempt of the ISO to go after the main drivers that are requiring the use of the load conformance. Again, this is a pilot program. We are trying to collect all the information that we have under this period to see how we can more effectively define guidance of what load conformance levels can be used in the real-time market. We will continue to report as we complete this trial and collect more evidence of how the market performs and the dynamics that we observe when we have this minimum utilization of the load conformance. Just as a reference, and you see that in the lower plot, the other pilot program that we have happened prior to the summer of 2023. And it's just a perspective that we have tried this multiple times to improve the operation of the real-time market. That's all for this section. Let's pause and see if we have any questions, Brenda, or comments.
I'm going to give a few seconds to see if anyone has a question to raise, but I don't see it. Many raised hands at this time.
Okay, let's keep going then. And this is the last piece. This is just an hourly profile for the 2025 period, broken down by month. And the trend is just telling you typically how frequently, how much we apply load conformance in the hourly ahead process. This is the HAS process. Typically, it's a very well-defined profile. We use load conformance for both, for positioning resources towards both the morning and the evening peak. And the dotted lines are of interest here because that reflects the time where we are doing the trial, where the utilization of the load conformance has been minimum. And you can see the values significantly reduced for both December 25 and January 26. That's all what we have for this section. Do you have any comments, Brenda? I couldn't catch that.
No comments. That one's just for internal.
Okay. Thank you. Let's move on to the next topic then.
Okay, so my name is Kyle Pelham. I'm part of market analysis, and I'll be taking us through bid cost recovery and then later down the line, congestion and CRRs. This is a new section to the MPPF. In prior sessions, we've included BCR metrics amongst the other categories, but this quarter we're going into detail specifically on the fuel types across the ISO, VIM, across different markets in the ISO. So next slide, please. Yep. Oh, thanks. Yep. So a couple of highlights here is, regarding the ISO and the IFM, 2.8% of all bid cost recovery was allocated to storage resources, with 96.7 going to gas. We covered the bid cost recovery in the RUC in the previous section. Again, southwestern areas accounted for approximately 67% of the total bid cost recovery for all WIM entities. Also, for the ISO, gas resources took up 82% of the BCR, while storage resources took up 9.2% of the BCR in real time, again, for the ISO. Next slide, please. So to kind of go into detail on one of those points, what we have here is monthly BCR in the WIM broken out by the regions. And as we just mentioned, 67% has been consistently going to Southwest regions, and we can see that trend, keeping along throughout 2025, and more specifically Q4 2025. Next slide, please. And now we're starting to break into some of the new material where we look at the specific fuel types. So here we have the yearly totals broken out by their technology. So wind, solar, hydro, storage, gas, and then everything else is allocated to other. Again, to go over the proportions, for 2025, 96.7% of BCR in the IFM went to gas, while 2.8 went to storage, with kind of very small margins going to the other resources. And you can see that reflected on the graph. The large proportion of it is yellow, representative of gas, and then we see the small sliver of blue for storage, and then everything else is so small that you probably can't make it out. But next slide, please. So this is the same data, but now broken out by month. So same concept. You can kind of start to look at how trends have progressed across the year into Q4. We have a big uptick, leading into Q4 for gas resource BCR. Again, storage is a very small proportion of our monthly totals. Next slide, please. Now, doing the same exercise, but this time for the real-time market for the ISO. So for gas, we have 82% of BCRs to gas, 9.2 for storage. Overall, total of BCR in the WIM, the total BCR for the ISO and the RTM has been very close to what we saw last year. Next slide. Again, similar exercise. Now we have it broken out by month. Next slide, please. So now kind of zooming out of the ISO, now looking at the entirety of the EIM, 81.8% of BCR went to gas resources, with 8.4 going to storage, with the remainder to the other technology types. Next slide. Again, broken out by month, same proportions, just now we look at it from a monthly view. Next slide. Another thing we wanted to do was to single out storage. So specifically, the bars now represent the BCR just for storage. We have this for the ISO broken out into real-time and IFM. So the yellow being BCR in the real-time market, the baby blue, light blue for BCR in the IFM, the day-ahead market. And then additionally in red, we have a monthly proportion of total BCR. So not necessarily respective to the bars that you're seeing on the screen, but going back to the previous slides, if you took the proportion of storage against the entire rest of the stack, these are the monthly proportions that we'll be seeing. And again, so storage resources are making up 9.2% of BCR in the real-time market for 2025. Next slide. So we do this again, but now for the entirety of the EIM. Here, again, to repeat it, 8.4% of BCR was allocated to storage resources. Yes, that was a quick run through of any of this, so, please please ask any questions that you may have, any follow-ups, we'll be happy to go into that. Go ahead. I think we have one from Alva.
Let's go ahead, Alva, and then Callie, and then Kathleen. Alva, go ahead. Introduce yourself.
Thank you. Yeah, this is Alva Svoboda, PG&E. One thing about I think it applies to both of day ahead and real time, but especially day ahead. Would you be able to distinguish BCR due to out of merit dispatch from BCR not due to out of merit dispatch, which would presumably be due to hitting a state of charge constraint and not being able to dispatch? Because that sort of leads to the question of how is there justifiable BCR not considering state of charge? In other words, is the CAISO sometimes dispatching storage uneconomically?
Yeah. Thank you, Alva. We understand the question. I would say that there could be some level of approximation that we could do to try to come with some breakdowns of the BCR by reason. It would be an approximation. I think there has been some of that discussion in the storage policy discussion.
Right.
At this point, we don't have that readily available, and I have to tell you that it could become quite complex to try to do justice to have that type of breakdown by the different reasons. So it's something that we may consider, but I don't want to have something readily available pretty soon.
Yeah. And an approximation might be just fine. To say that it's almost all one sort or the other would probably answer the question. But thank you.
Yeah.
Next, we have Callie. Let's go ahead, Callie.
Hi, it's Callie Wells with WPTF. I guess I have a little bit more of an ask because I know in December the CAISO made some changes to how they're calculating BCR for storage resources, and I understand you guys only have 1 month worth of data. Actually, it might even be a little less than a month because I don't know the exact date it was implemented. So I guess my ask is, maybe at the next NPPF, if there's a way to kind of do a deeper dive into the impact that change had on the BCR that storage resources are receiving would be great. And if you guys can speak to kind of what you're seeing, I'd appreciate that as well. But I understand if you don't have a ton of data at this point.
Yeah, thank you, Kelly. I think it would be naturally a good place to be for the next round, just given how recent that was done. So you are right. We don't have too much data, and we want to at least have some critical mass to be able to trend some metrics. And so we will consider that for the next NPPF.
Okay, thank you.
And then we do have Kathleen. Go ahead, Kathleen, for question.
Thanks, Kathleen. Distra, I think you answered my question, but I was going to ask you to confirm whether because that December settlement update that happened was going to be retroactive, and I don't remember how far, but it was a few years. I thought a couple of years. And I was just going to ask you to confirm if this data included the change or not. But I think you said no. Is that right?
It includes the change for the December, and they are doing the retroactive, but then that'll be based on the settlement cycle. So
right.
as we
okay.
the settlement cycle, so you won't be able to see anything right now for probably early in the year, but as we move forward, they'll process that through the settlement cycle, and they'll keep updating those.
Okay, great. Thanks, Abhishek. That's really helpful.
No more questions in the queue.
Awesome. Thanks, Brenda. I think that wraps up the BCR section. We can move on to the next chunk. Okay, so up next, I'll be taking us through the congestion and CRR portion of the presentation. Next slide. So again, a couple highlights. Congestion in the day-ahead market. This is pretty typical. What we saw, the lowest levels in Q4. Also, typically, something we've been saying is, most of the congestion is collected across solar hours. 2025, for the most part, going from season to season, year to year, we've seen lower levels than the previous 2 years, and then consistently pro rata funding has provided surplus back to load. Next slide, please. So here to start off, we just have the monthly total of net congestion rents broken out into their constraint types. Focusing in on Q4, we have a downward ramp of total congestion rents. December has historically been our lowest month as you look back into 2024, 2023. So this is normal. Next slide. Now breaking out, completing the year, we can look at the totals in comparison to past years. 2024, we see a ton of intertie congestion. A lot of that is allocated to the MLK weekend event that we've covered in recent presentations, so that's a bit of an outlier. But looking at the yearly totals, 2025, 483 million, roughly, down from 537 in 2024 and 572 million in 2023. Again, most of this is allocated to flow gate constraints, and we see most of the downturn in totals across the solar hours. We see the tails are roughly in proportion to previous years. Next slide, please. Again, to kind of complete the year, we can now look at totals by CRR seasons, which are broken out into the typical yearly quarters. As we previously mentioned, season 1, season 2 are down from previous years. Season 3 is also on the lower end, but still, I think 2024 beat it out by a little bit. And then season 4, of course, has been historically our lowest season across all years, and we're just seeing 79 million for Q4. For Q4. Next slide, please. So going into CRR performance, this is a little bit of a busy slide, so feel free to ask questions. But here we have the breakdown from CRR notional value across the months since 2021. Also adjusted payment, and then CRR deficit, and then we can kind of if you can barely see it, we have the CRR surplus and then the surplus plus auction revenues. The big takeaway here is that, for most of 2025, the ratio of notional value and adjusted payment has been pretty consistent. Looking across the board for 2025, we're seeing an average ratio of about 68% of the adjusted payment to notional value, and that ratio has stayed true across Q4. One thing to add too is that the variability of that ratio has been consistent compared to previous years. We do see a lot more jumps, where some months are better than others and some months are much worse than others in past years. This year we've been pretty consistent, relative to the magnitude of congestion that we've seen in that month. Next slide. Additionally, we still have the running counterfactual for pro rata funding. We have green being, the amount of surplus allocated to load with no pro rata funding. You can see that for most months it results in a, uplift charge. And blue being, the current implementation of pro rata funding, we consistently see a surplus back to load. Next slide. Oh, yeah, okay, yeah, I think that sums up the CRR portion, so yeah, happy to take any questions. If not, I'll pass it over to the next speaker.
No questions at this time.
Okay, I'm Hannah Mooring. I'm also with Market Analytics, and I'm going to go over gas and power index prices as well as total market costs. So in summary, we had a pretty calm summer and post-summer, and there's also very limited gas volatility, and so because of that, prices were stable throughout CAISO as well as EWEIM. Wholesale electricity costs across 2025 were lower than those in 2024 and 2023. If you look at the numbers, it's Total costs in 2025 were $8.46 billion, which has come down significantly from 2023, where it was $14.5 billion. For next steps, the ISO staff will be continuously monitoring Western bilateral markets and the forward prices, and then provide updates on those impacts to CAISO markets and to stakeholders. Next slide. So as I mentioned earlier, prices were relatively stable throughout the whole of 2025, and that trend continued through Q4, where the average cost per megawatt hour was below $50 for all of Q4. Next slide, please. So real-time prices were also stable. If you look relative to the last couple of years, 2025 was pretty flat. This is true for basically all of the different regions. Next slide, please. Next day, gas prices were slightly higher compared to 2024. However, they were still very stable compared to prior years. So because of that, we saw less volatility in gas prices as well as in power prices. Next slide, please. Western next day gas prices returned to, basically in the summer of 2025, we saw a dip in the Northwest Sumas hub. It separated from the rest of the other hubs, but then in Q4, starting in October, it came back and joined the other hubs, so that they all kind of stayed in a similar zone. Next slide, please. Future gas prices for October through December started declining over the summer, and then as the summer came to an end, they started rising slightly for October and November. As their date grew closer, the prices dropped a little bit. However, in the prices for December kind of leveled off and then rose slightly before December. Next slide, please. Next day, on-peak bilateral power prices remained relatively stable, as well as relatively low, staying below $85 per megawatt hour through all of Q4, including September. Next slide. Future on-peak prices for delivery in October, November, and December showed some price separation between Mid-Columbia and Palo Verde, but otherwise, next slide. So, as I mentioned, like, costs generally were pretty stable, and in fact, like, we saw a pretty mild summer, so the highest costs were in January of 2025. Next slide. So monthly totals for October and December 2025 were lower as far as total costs, but in November it was slightly higher, but not too much higher than 2024, but still like relatively low compared to 2021 and 2022 and 2023. Next slide. And except for Q2, total costs in 2025 were lower than in 2024. If you look at the table, it shows the total wholesale electricity costs as well as the average cost per megawatt hour. And as you go from left to right, you see a pretty steady decline from 2022 to 2025, with 2025 being, again, the total wholesale electricity cost being $8.46 billion, and the average cost in dollars per megawatt hour being $40.52. Next slide, please. the ISO's real-time congestion offset costs decreased coming out of the summer. The real-time imbalance energy offset was actually net 15 million. Next slide. The Pacific Northwest was allocated about 66% of the total net real-time congestion offsets. You can see all of those values in the table where Pacific Northwest has that 50, and all of the other are significantly lower. Next slide, please. For real-time imbalance energy offsets, the costs have been relatively low since January of 2024. Yeah, I think that's all. I think that's all for this section. So happy to take any questions.
Just reviewing, if there's any questions, please raise your hand. If not, we don't have any questions in the queue.
Okay, I'll take this section. This is Mihir from Market Analysis. Let's talk about resource efficiency evaluation in the AET, similar to what we typically do in our MBPF slides. So here we talk about the failure and passing and failure of VAAs for the resource efficiency evaluation test for entities participating in the WEIM. We're just focusing here on the flex ramp failures. So this is flex ramp up, you can see for July through December, and we have a row for each VAA. Overall, we see that's a very small level of failures, mostly less than 1%. There's just one instance with higher than 1% in November, and a lot of zeros. Let's go to the next slide. This is similar, it's the down version, flex ramp down failures, a similar trend. Most of the values are below 0, below 1, a lot of zeros, just 2 exceptions in December, where the flex ramp down failures were above 1. And of course, it's going to vary from BAA to BAA, typically correlated with the amount of renewables each BAA has represented in the system. But for Q3 and for Q4, low level of failures shows how non-tight the conditions have been. And for ISO and for the West. Let's go to the next slide, please. So this is the slide covering the Assistance Energy Transfer Program. This is a program that allows areas to receive energy transfer assistance when they don't meet resource efficiency evaluation requirements. In this chart, we're seeing that there's a couple of dimensions going on over here. We see how frequently BAAs opted in to the program, and this is color-coded by day. So if there's a color, that means that the entity opted in for that specific day. The other dimension is the black dots. These are overlaid on top, which represent the instances where there was an RSE failure for that entity on that particular day. So the thing that's important and where this program is actually material is where the black dots are overlaid on a colored square. That's when there was a failure and the entity opted in and secured participation in the program, which means that they were able to rely on these transfers even though they failed the resource efficiency evaluation test. And yes, this is where the program is most material. So we can see that participation for Q4 dropped from 10 entities to 5 entities, and there were some instances where there was failure at the same time that entities opted in and were able to benefit from the transfers. It's a pretty sharp distinction from Q3 to Q4. It occurs right at the end of September, where we dropped from 10 entities to 5 that were participating. And 4 of them stopped participating right around the same time, as you can see over there. Okay, next slide. So the costs, and once the entity has opted in to the Assistance Energy Transfer Program, and there was a failure for the RSC, and the market was clearing, the market cleared, and it allowed the entity to rely on the additional transfers through the market, it's being incurred at a specific charge, where these reliability benefits from participating in the program are incurred. And this is what this slide is reflecting. We're seeing that the total cost in Q4 was just about $750,000. In Q3 was over $1 million. In Q3, see that cost is primarily driven by the Labor Day events around early September. Okay, let's go to the next slide. Market disruptions. Let's go into this section. So as part of last MPPF in October, CAISO introduced market disruptions and enhancement that was being explored to mitigate the number of market disruptions that were being observed in the market. There's a variety of reasons why market disruption occur, and one can be because there's an infeasible constraint that could be caused by a specific resource. And the tool that was used previously was to make that resource non-participating in order to allow the market to solve. So this enhancement is eliminating that practice and replacing it with a more automated solution. And so what the market is, and let's go to the next slide, please. So this enhancement is identifying the infeasible constraint and size of that infeasibility, and then the market then relaxes that constraint by the size of the infeasibility and allows the awards and schedules to be cleared for all the other resources. And that resource that is creating the infeasibility also gets an optimal dispatch. The caveat that there may be some situations where that resource with the infeasible constraint may not be able to meet its dispatch, but it's expected that those instances will be infrequent and potentially minor. So let's go to the next slide. And so here we see the performance of the market disruptions. This enhancement was implemented November 18th. So the chart shows the frequency of market disruptions by market type in the real-time market, FMM, HASP, RTD. You see that the red bars, effective November 18th, essentially reduce in frequency. We also are showing the yellow bars, which are the avoided market disruptions as a result of this enhancement. And there were 6 of these instances out of 13 possible RTD market disruptions, so about half of the disruptions in RTD were avoided as a result of this enhancement. And moving forward, CAISO will continue to monitor and report on performance of this market disruption enhancement. Okay, let's see if there's any questions on these.
No questions at this time, Mahir.
Thank you.
Let's go to the next slide. Can you skip this section since you already covered it?
Okay, hi, my name is Jenny Arash. I'm going to go over some recent market issues. Next slide. So the first issue that we'd like to talk about is where RTD mitigation, there was a software issue that impacted specifically RTD interval 11 and 12 due to a bid processing issue. And as a result, this may have led to over mitigation of some resources. So we were designating constraints non-competitive when they may have been competitive. And we discovered that this issue was present from March of 2021 to September of 2025. And we put a fix in for it. Next slide. So some of the impact here for this 5-year period. So this chart shows that in 2021, there were 99 unique constraints that were possibly over-mitigated, but there are a lot of intervals that we run, so it really only could have impacted 0.5% of all the RTD intervals that year. And so on, so that for the 5-year period from 2021 to 2025, 299 flow gates and nomograms could have been impacted, but overall it impacted only 0.35% of the RTD intervals. Next slide. Okay, an issue that occurred earlier in the middle of 2025, on July 7, 2025, the ISO in designing a nomogram associated it to the incorrect balancing authority, not to the ISO. And so this OMS nomogram was active and binding with the shadow price for 3 hours on July 7th in the day ahead. But because we didn't have it properly mapped to ISO, the SP tie transactions did not accurately reflect the MCC of that nomogram. So any internal generators were not impacted. It's only the SP tie or import-export resources that were impacted. Next slide. So we did an estimate of day-ahead settlements energy for those interties, and overall, they should have received a lower charge for energy to the amount of $10,000 lower. They should have been charged less. Unfortunately, we discovered this issue after the 3-day price correction time horizon for day-ahead, so we could not correct these LMPs, and these current charges will remain in place. Next slide. Issue number 3. So this is about the bidding expectations for co-located resources that use the off-grid charging indicator. So co-located storage resources providing FlexRA can also use this bidding parameter called the off-grid charging indicator, OGCI. And so it prevents resources from receiving market awards to charge from the grid and only allows charging when the co-located solar is available. But those storage resources are able to provide flex RA for their charging and discharging range. So, you know, up to twice the value of their Pmax. And so if the OGCI is active, you really don't have access to that charging range unless that co-located resource is generating. And so this whole scheme is not captured by rain penalties. Next slide. So we're going to put in, well, we've put in these 2 PRRs. I know they're not visible to you due to some upgrades that need to be made to the BPM system, which I think will occur here in early February. So you'll see PRR 1658 for changes to the market ops BPM that co-located storage resources using this OGCI should be aware of their bidding obligations under section 37.3.1 of the tariff, that they must submit feasible bids. And then another PRR 1659 will be to the reliability requirements BPM to clarify submitting accurate flex RA. And that storage resources receiving their effective capacity based on their charging range should be mindful how charging limitations can impact their ability to meet must-offer obligations for flex RA. And so those will go through the normal 2-month BPM process upcoming here. Next slide. Okay, we've had a few incidences of incorrect use of default energy bids. So from a period of September 22nd to October 2nd in 2024, there were 2 resources that use a special distillate index for their negotiated DEB, and instead we used a $2,000 DEB. And then in June to July of 2025, a WEIM resource selected the storage DEB option in our master file, which is not available to WEIM resources. The storage DEB option isn't available. And then just last month, from December 12th to the 19th, there were 8 WEIM resources that had inactive negotiated devs that we accidentally made active in production. And so in all these instances, the incorrect devs were not actually used for dispatch and didn't impact market prices. Next slide. Oh, okay, we're going on to Alicia and forecasting for the last one here.
Maybe I'll just keep my video off. I'm Alicia with Short-Term Forecasting, and I will be presenting this last issue. Right, so this is more a theme of issues similar to the last slide that we wanted to bring, where data input errors at the BAA or transmission level have impact to forecasts. This isn't one specific BAA. There are a couple BAAs with sort of one-off issues per BAA, but altogether that kind of creates a theme. We wanted to emphasize that data quality is critical to maintaining forecast accuracy, and that any impact to telemetry quality will impact real-time load forecasts most directly, because our very short-term load forecasts, sort of in the next 5 minutes to a couple hours ahead horizon, are load following, so they will trend with current telemetry. And then on a slightly longer term horizon, if impacts to telemetry continue to occur on an extended basis and impact load forecast performance, that starts to have impact to uncertainty products like IR and FRP. So for examples of recent errors, there were new or existing market participating battery resources that had telemetry that was incorrectly incorporated into BAA level load. Because they're market participating scheduled by the market, we want to exclude them from the load that we are forecasting for, but their telemetry did make it into telemetry on certain days, so our load forecasts followed these battery impacts. And then another instance was a new co-located resource generation lowering load. So again, a resource that should not have been in telemetry made its way into the calculation, and load forecast did follow that. The visual to the right just shows an example of this, of battery impacting and lowering load and raising it at different intervals, and our real-time forecasts sort of following that trend. When this occurs, it can have major impact to forecasts, and demand forecast spread on this day was about 10% of max load for the BAA. That is it for my slides.
I do see a question. Callie Wells, your line will be unmuted. Please introduce yourself.
Hi, it's Callie Wells with WPTF. I apologize. I actually had a question back, I think, on one of the slides Jenny was presenting with the BPM changes. And it's more of a process question, because I heard you say that there's some issues with the system right now, and we can't see on our end those PRRs. Do you know if the CAISO will be starting kind of the timing we have for submitting comments at the time we can see them, or is kind of the clock running now? And if so, how's the best way for us to engage in these PRRs?
Let me follow up on that one.
Okay, I appreciate that. All right, thanks.
Thank you. I don't see any other questions in the queue, Jenny and Leisha. Leisha, I think this is your slide.
This will actually be Amber.
Oh, okay, got it. Yeah, Amber's there. Thank you.
Hello, everybody. Today, I'm going to talk about an enhancement that we're making to the persistence forecast. We've named it Solar Neighborhood. I think you guys will see why shortly as we kind of go through it. Next slide. So a little bit of background for those that are not quite as familiar is we do have a methodology in RTD, both the binding and the advisory runs for a persistence forecast that does run in our market software. And it's been activated for both wind and solar resources since 2018 for the CAISO BAA. And then since then, as the WEIM footprint has grown, it also has grown for the WEIM entities over time. That methodology requires solar persistence, where at the solar resources, you have to have a reference curve. So essentially, we develop a curve that shows the sunrise, sunset profile for each solar resource ID. And that's a prerequisite before solar persistence can be activated. In the current BPM, the prerequisite of it is 1 year of settlement quality metering data on the solar resource ID. So that means as you have new solar resources coming online, that those resources would have to wait 1 year before persistence for that solar resource is activated. We've been exploring potential new options to extend the benefit of persistence to the newer solar resources that are under that 1 year time frame within the EIM as well as the ISO resources. And that was where the solar neighborhood methodology has come from, where we could utilize and have been trialing the use of an existing solar unit that has some established criteria, which I'll talk through, as the surrogate to create the reference curve. Our intention is that it maintains the same accuracy as our persistent methodology, so its accuracy needs to be better than the external forecast service provider forecast, because that's where the benefits come in those RTD timeframes. Next slide. So some of the qualifications as we've been trialing with entities, and thank you again to the entities that have allowed us to test this out in some of their areas, is that we are requesting a similar unit type to the requested resources. We know that the size may be different, like you might have a 20 megawatt resource and a 10 megawatt resource, for example, but the similarity of that resource type is critically important, not as much the size. So similarity includes, but is not limited to, the technology type, the resource management, and the equipment installation that you have for your solar resource. At this time, the surrogate needs to be within 50 miles of where the resource is going to be added or is added onto the system. And that resource that is being used as the surrogate has to have existing reference curves to the ISO as well. And then, of course, it also is not a hybrid resource type. Next slide. Here are some result outcomes. We look through this time period. This was October of 2025 through some days at the beginning of November of 2025. A mix of resource IDs as well as a mix of miles away from the surrogate resource to the newer resource. On the far columns, we'll go across its resource ID, its PMAX, so what is the maximum capacity of that site in comparison. MAPE ELF represents the external forecast service provider forecast, and then MAPE RBH is the new methodology of neighborhood being utilized with that surrogate reference curve. And then that last column is the miles between the surrogate and the newer resource ID. You can see, as you kind of go through in glance, that the overall percent, you have improvement in the MAPE of the neighborhood methodology over the ELF methodology. So we will continue to move forward with this change, knowing that we do see benefit in being able to use these surrogate reference curves to help activate persistence earlier for resources within the CAISO BAA, as well as the WEIM and EM footprint. Next slide. So some of the next steps that we have is internally we're drafting BPM changes to help with the clarity that's in this slide, as well as putting those into BPMs for awareness. That was finished this month, and we are going to be submitting those into the PRR process that will be going to the February 2026 PRR process. So if you're interested in this, please flag that will go into the February discussion. And that following the PRR submittal, we will start going through the publication and implementation for those resources that we have trialed. And if you have requests to have other neighborhood resources be utilized, that those could be submitted to us through City Ticket. And City Ticket process that we're going to be utilizing for this will also be documented and described in the PRR. I will note for CAISO BAA resources, it is something that you, as a CAISO BAA resource, can request. So you could submit a City Ticket to request the surrogate resource that you know that meets the specifications, and for us to look at that and develop it and get persistence activated for that solar resource that is coming and newer on the system. But we also will look internally to the CAISO BAA resources, knowing that we have location mapping of those that could qualify as well. As we get through that process, before any resource is activated on persistence using the neighborhood methodology, we would use the City Ticket process to communicate and let the SC know that that resource would be turned on to persistence with the neighborhood methodology. And with that, I will pause and see if there are any questions.
Thank you, Amber. I don't see any questions yet, but if someone does have a question, please raise your hand. I do see Alva from PG&E. Let's go ahead and unmute him.
Just to make conversation, Amber, when you select a resource within 50 miles, are there other attributes you're looking for, or is it, is there could be a lot of resources within 50 miles? So what's the criteria there?
Yeah, so there are other attributes if you go back. Want to make sure that it's a similar unit type. Some of these attributes also on size, the resource we do want above a certain size that is being used as a surrogate as well. There'll be a table that's drafted that goes into the PRR that helps describe those. But there are specific attributes that we are looking for. Most of them are highlighted within this slide, and then we did add a couple extra as we drafted the PRR.
And you might have multiple candidates, right? Would there be a criteria you'd use to select among them, or would you use an average, or what would that be?
I think it would be criteria to select with them. You would just want one resource, and I think one of the things that you would go to is the equipment type, which one has the closest equipment type.
Okay, and you're saying you'd work with the new resource on making that selection?
So you have an option, right? You can work with the new resource to make that selection and bring those forward. For example, for you, if you have any from PG&E that you're like, I really want this new resource to be on persistence. I know there's another resource right here. You can submit those two in City Ticket and then submit both of them to us, and we'll evaluate it and move it forward. The other thing that we will do for the CAISO BAA resources is that as this gets going, it's going to take us a minute to get all the resources right. But we'll start going through them as well independently and flag some of those that we see. And then we'll be in contact with the SC before we activate neighborhood persistence for them.
Right. And would it be good or bad if you selected the same resource as a reference for multiple other resources? Would that tend to be a good approach in your mind, or a poor approach?
I think that it's forming the reference curve, right? So as long as it provides the right shape to form that reference curve, I think, and you see the accuracy, and before any resource moves forward, we do run this accuracy report. I think you're okay. And then the other thing is, once that resource gets a year of data, we'll reanalyze if anything needs to be updated as well.
Great. Thank you for answering all those questions. Appreciate it.
No problem. Great questions.
Thank you, Amber. I don't see any other questions in the queue, and I think we're wrapping up the market market topics that we went to discuss with Guillermo's team. Unless, Guillermo, do you have any ending remarks for your team before we close your agenda items?
Thank you, Brenda. No, I think that's all what we have intended to cover today. Thank you for the participation, and we have taken note of the recommendations and suggestions for future MPPF, and look forward for the next quarter discussion. Thank you.
Thank you. At this time, I do still see Becky Robinson. Want to do a quick audio check with her. She's available to kick us off early for a policy. Hi, Becky, I do see you on video as well. Can you try again? Maybe your audio is a little softer.
How's that now?
Yeah, it sounds good.
Okay. All right, thanks, Brenda. Well, good morning, everyone. I'm Becky Robinson, Director of Market Policy Development, and I will be providing an update on our policy initiatives today. We could go to the next slide, please. So just to jump in with those, the first item we have up is on our Congestion Revenue Rights Enhancements Initiative. And this one, we spent a lot of time, I think last year, with stakeholders and conversations around congestion revenue rights, and sort of in the scoping phase of that initiative. And we have wrapped up that scoping phase and we're moving into policy development now in the new year, focusing on the key challenges that the scoping phase working group identified, which include improving revenue adequacy and auction efficiency, as well as updating CRR product definition, and particularly thinking about time of use periods and the potential use of storage as a sink rather than just a source in the eligible CRRs to better align with evolving hedging needs of a fleet that has a significant penetration of solar and storage resources. So thinking about how that existing on-peak product could be sort of more granular to line up with solar hours or with charging versus discharging hours for storage resources. And so here we've got some recent dates, some activity of that initiative. We've put out a couple of papers in the December-January timeframe, and the initiative just had a stakeholder meeting last week to get going, talking about those papers and the work ahead this year. And of course, that work will continue to be informed by another initiative, which we'll talk about in a little bit, on EDAM, congestion revenue allocation, to make sure that all things congestion revenue are moving forward in a way that makes sense from a variety of angles. And then as well, for the straw proposal item that we put out, which was just on that product definition piece, that was the December paper. For that item, you will see in there the proposed decisional classification for that would be for the ISO Board of Governors to have sole authority over that item. All right, I'll take any questions on this slide. And I can also take questions at the end. But Brenda, maybe if you see any hands, feel free to stop me. But in the absence of that, let's go to the next slide. Okay, great, thank you. So next initiative, the Demand and Distributed Energy Market Integration, or DDEMI. That's another one where we're transitioning from the scoping phase into policy development now in the new year, and anticipating and getting an issue paper out there later in Q1 this year. The scoping phase of that initiative saw many great ideas. That was a very collaborative, lots of folks showing up with ideas for improvements and ways to enhance the ability of demand and distributed energy resources to participate in our markets. But so far, the key areas of focus that we're thinking as far as moving forward with in the near term for policy development are informed by that scoping phase working group. Those include, listed here as these bullets, market models, either developing new ones or enhancing existing ones, market models to support demand-side bidding or exporting from distributed resources, updating the performance evaluation methodologies, streamlining and simplifying participation, the devil's in the details there, and notably accommodating large load demand flexibility, which is a large topic nationwide, and there's many efforts going on around that. We're excited to be talking about that issue as well. So there was a discussion paper wrapping up the scoping phase of that working group last November, and yeah, lots of work to come. And I see we have a hand on this item.
Yeah, we do have Alva first, and then we're going to go to TJ Vargas. So let's go ahead.
Alva from PG&E. Just a question on the decisional classification. If you do make any changes to market models, are those expected in the future to go to the combined, the WEM or EDAM Board of Governors rather than be decisional for the CAISO Board of Governors?
That's a great question, Alva. And this effort, I know there's, like some of our efforts, this is one where there are some programs that we sort of think about in the California context versus our market rules, say, which nominally, anything in the market rules in this space, my understanding, don't have a lawyer here with me, is that those apply generally, right, to any and all market participants throughout the regional market. And so I think there may be particular pieces that are, in terms of, for instance, resource adequacy things where there's sort of a California application of those versus other things that are generally applicable. So I think we need to navigate those on kind of a case-by-case basis. But to I heard your question as changing market rules. I think if it is changing the market rules, since those are, to the extent that those are applicable to all market participants, then I think I would expect that our legal counsel would determine that those would be going to the primary authority of the governing body. But I might be getting ahead of myself without a specific example in front of me.
Thanks very much. I appreciate you're just thinking about it. I'm not expecting you to be committing to it. It just looks to me like all of these bullets are more on the side of the market model, essentially, or the sort of standard validation of these resources. And so I was just curious as to whether it's really a TBD or sort of implicit in those areas of focus that it would be something that would be determined at that multi-state level rather than just for CAISO. Thank you.
Sure. No, and no, thanks, Alva, for the question. And just to be clear, right, if there are things that are sort of applicable only to California programs, for instance, today we have the RDRR program, which I think is sort of birthed out of a settlement agreement in California between specific parties. There could certainly be things that are, not to say that, well, that are applicable sort of to the California market. So I don't want to rule that out, but yeah, I think we'll have to sort of take the specific items to our general counsel's office to kind of see how do they fall in terms of where the governance should lie on those.
Thanks again.
TJ, you're next.
As mentioned, I'm with the Department of Water Resources, and so I have two questions. On the second bullet point where it says the key areas of focus, is that meant to be a summary of all the topics, or is this kind of a summation of topics that are going to move forward? And then the second question I had is, could you expand a little bit about accommodating large load demand flexibility, what that might entail?
Sure. Thanks, TJ, for the question. So the key areas of focus, I don't think this is meant to summarize all of the 31 topics. I think the discussion paper counted up in terms of ideas that were raised and suggestions for areas of work. As we've sort of thought about this initiative and kind of what, how to move forward on this, I think we are of the mindset that some of those ideas might be more ripe for near-term policy development than others. And so we're trying to sort of identify where is there the most bang for the buck in terms of moving forward. I don't mean, this list is not meant to be sort of the definitive, you don't have a say anymore if you don't have your issue listed here necessarily, but I think it is meant to kind of represent at least our thinking so far, which will be, you'll see more of an issue paper forthcoming. But, of those significant list of items that folks put on our plate to think about, or that, that folks are raising for the demand and distributed energy community to think about, which of those, how do we see the sequencing and phasing of work that would move some of those forward, even if we sort of can't sort of, practically speaking, move all 31 items together all at once on the same timeline. So I would say more to come in the issue paper, and I do appreciate your point that there are a lot more suggestions and ideas than are represented on this slide. And then second part of your question.
Could you talk about kind of the details of the large load demand flexibility?
Yes. So that's an area where we do want to think about and have heard interest from the community in thinking about where these new data centers are going to be. Potentially there is backup generation capability or potentially curtailment of the data center or other large load use. Thinking about the desire that we've heard to kind of have models and think through models for how can we harness that flexibility if that is the desire and if there is a market need for that in terms of demand response or basically as a type of demand response, whether that is sort of a reliability driven demand response or whether that is a price sensitive consumption, but kind of thinking through what are the existing models we have in that space, existing demand response models we have, what could be sort of most applicable in a large load context, and making sure that those are well understood options and that those will work, I guess, for the task at hand in terms of anticipating some significant large load growth across the regional market footprint.
Okay.
So exploring that area.
But does large load presently imply data centers?
No, not necessarily. Sorry, I took it there, but I think large loads is broader than that.
Thank you.
So not meaning to slice that too finely there. All right.
Thank you, TJ. No more questions.
All right. Next slide then. Okay, EDAM congestion revenue allocation. So this item you'll remember from last spring timeframe, I believe. We talked a lot about EDAM congestion revenue allocation, and at that time, when we got board approval and later FERC approval on sort of the plan for EDAM Day 1, we also committed along the way to have to bring that conversation back up to kind of think about future evolution of the market design on allocating congestion revenue among EDAM BAs, which is sort of a separate question than the question of congestion revenue rights within the ISO BA, those instruments and how those work. But so here, again, just allocating the congestion revenue that the market collects as a whole from the day-ahead market among the EDAM balancing areas. So we have kicked off this second phase of this effort in December through a stakeholder working group, and additional working groups this year will be focused really on the development of guiding principles as we consider potential future design options and evolution. And that effort will also be, continuing to develop analysis based on EDAM market simulation and parallel operations data which is the second phase of the analysis that the Market Surveillance Committee market expert recommended. The first phase of that we've already done, as you may recall, and have presented on in this initiative and to the board and governing body, and that was looking at EIM data, and now we're at a place where we're in market simulation for EDAM, and parallel ops will be beginning soon. So looking to do some analysis with that data as well to kind of further inform expected outcomes and range of market results in terms of making sure that we are informed and anticipating what to see coming out of the market when that starts up on May 1. Any questions there?
I don't see any questions at this time.
All right, thanks, Brenda. Next slide, please. Okay, storage design and modeling. The scope of this initiative, if you've been following it, you're familiar with this list of 4 topic areas: outage management, uplift, mitigation and default energy bids, state of charge management, and then mixed fuel and distribution level resources. Mixed fuel being, of course, our hybrids and co-located resources. So in December, we put out an updated discussion paper and an issue paper combined on these topics that really, sort of in that discussion paper mode is building on the stakeholder engagement during the scoping phase to outline problem statements, guiding principles, and conceptual policy recommendations. And then it is really kind of examining the relationship between uplift and market design, different drivers for why resources have the state of charge they have, and is exploring frameworks for long-term enhancements to bid cost recovery and default energy bids, rules around those. And so, sorry, I should also say there will be an upcoming paper, so stay tuned for that, on the mixed fuel and distribution level resources and outage management, 2 papers there. And I know that effort initiative is already been, I think there was a meeting on that last week as well, in terms of getting that conversation going again in the new year. And a fair amount of work there to tackle, but I know a lot of ideas and great stakeholder engagement on that effort. So thanks everyone for that. Any questions on storage? All right, next slide, please. Okay, price formation enhancements. So this item, we have a straw proposal that we put out back in August on both scarcity pricing and market power mitigation. Have gotten a lot of good feedback, on that. And we've highlighted this item at a recent governing body meeting back in October. Did a little spotlight briefing on scarcity pricing in particular, with some stakeholder presentation, a stakeholder presentation and some stakeholder comments as well on doing something more comprehensive on scarcity pricing compared to what was in the issue paper, in the straw proposal itself. November, we spent exploring with stakeholders those concepts of doing something and a couple different options for doing something on comprehensive scarcity pricing. And then just a couple of weeks ago, we had a general session with the Market Surveillance Committee, and these topics, both topics, market power mitigation and scarcity pricing, were discussed there with the Market Surveillance Committee. So just to hear their thoughts on these topics, as well as continue to explore those concepts and issues. And so a lot of work to continue these topics, exploring those. And as far as decisional classification in that straw proposal, we thinking about how these are affecting the market rules for pricing and so forth, as well as for market power mitigation throughout the regional market footprint. This would fall under primary authority of the governing body. Any questions on price formation?
I don't see any questions in the queue. Thank you.
Okay, thanks, Brenda. Next up, on resource adequacy, we recently presented decisions and received approval by the ISO Board of Governors on the Track 1 items you see here on modeling and default rules. realized my mic was up. Hopefully you could hear me before. But yes, track 1 and the visibility piece of track 3 recently was approved by the ISO Board of Governors last year. And we're glad to see that, and that approval that will be moving forward with FERC filings and so forth. On track 2, that work will continue this year. That is on 2 different topics, on outage and substitution processes, as well as on availability and performance incentives. So looking forward to that work continuing this year, as well as you'll see some additional bullets under track 3 in terms of additional resource adequacy topics that we will take up later this year. And I see a hand from Alva.
Alva, go ahead. Your line will be unmuted. One moment. Can we unmute Alva? Thank you.
Good. Hi, Becky. Going back one slide on market power mitigation, I really appreciate the way you presented the information here. One question I have is whether in your next paper on the subject of market power mitigation, you'll engage, and I would just urge you to at least engage with the criticisms that were raised at the Market Surveillance Committee session. I didn't understand everything that was brought up there, but I felt that they were quite substantive, certainly, and the implications that were drawn out that were quite substantial. So I just would hope that it wouldn't be a case of just simply ignoring the criticisms that were made there, particularly by Scott Harvey and Jim Bushnell, and so hopefully you'll address them in a way that makes it possible to advance the initiative. But I just thought that they were pretty significant from what I heard.
Yeah, no, that's good feedback, Alva, and I agree. I was it was notable the feedback from the MSC members on the MPM topics, and we've had some internal conversations to kind of assess, that in terms of, does that criticism amount to none of this is any good and start over, or is it, right. Which I don't think it is, but I do want to be. I think you're wise to provide that counsel in terms of making sure that we evaluate, what were they criticizing and why, and I think, I think at the top level, or a version of some of the feedback at least is that they were suggesting that some of the, in terms of the passing rates and so forth, looking at the groups and whether those improved or not, as we look at how the ISOBA plays into that, the passing or failing, it needs to be informed by the fact we don't test the ISOBA today, and so it's like, how much do you take from shift among things in the list of BAs, but that's I've got a particular chart in my mind, but it's probably not helpful to speak to it because it's not on the screen here. But I appreciate that feedback, Alva, and yeah.
Thank you.
Yeah. No, I agree. Okay. Thanks, Alva. All right. Next up, gas resource management. This item was approved by the governing body in December and had 3 main topic areas of tariff change, of items that initiative was moving forward. Those are listed here as the sub-bullets. So changes in the multi-day ahead advisory market runs, the so-called D+2, and so forth. And that is to let people know more in advance of what's the anticipated fuel needs before the day-ahead market, before we get into the day-ahead market timeframe, so that folks can make informed decisions during gas nomination timelines for those, especially for those early cycles in the gas nomination process. And then the second, second topic that initiative covered was additional options for cost inputs, fuel cost adjustments, and cost recovery. So thinking about how are resources representing their costs in the market, and how did the DEBs allow them to represent costs and so forth. And then finally, considerations for thinking about gas system limitations and how options for how that is represented in the market, and when such representation, like use of the gas nomogram and so forth, may be appropriate. So we are working on proposed tariff modifications in preparation for that FERC filing, as well as working on proposed BPM modifications that go along with this effort as well. Any questions on gas resource management? Next slide,
No
please.
questions.
Okay, thanks, Brenda. And then commitment cost bidding flexibility. So this effort is related to the gas resource management effort. It was sort of came up in conversation around gas resource management, but we are addressing that separately here. And so if you're not familiar, this is something, the commitment cost and default energy bid policy, or lovingly referred to as CCDEBI, was something that was approved back in 2018. And part of that moved forward in a FERC filing and was implemented in the tariff, but there was an element of that stakeholder initiative where the changes were never implemented, did not move forward into a FERC filing. And I think we're sort of taken over by other concerns at the time. And so, in particular, the changes relating to commitment cost bidding flexibility are those that did not move forward. But this came up in the gas resource management effort as a potential additional way of addressing related issues that were being discussed in the gas resource management effort. So the policy provided an expanded ability for resources to bid in their commitment costs, rather than just have a cost-based representation of those, and paired that with a new test for market power associated with those commitment cost offers, different than our existing market power tests. And so we are currently evaluating the implementation feasibility of that approved design, and we'll look to have a conversation with stakeholders later in Q1 of this year in terms of what are the next steps on that. Next slide, please. Okay, here we have a slide on our catalog and roadmap process. And just to note that we did, we've got links there to the final policy roadmap and policy catalog of 2025 and new year, new policy catalog and roadmap process. So we are currently accepting catalog submissions for new ideas for market policy initiatives from stakeholders. So if you have ideas of what's missing from this current portfolio of work on the market policy side, we want to hear about that. And so that window is open now, and then upcoming in March and April, there will be stakeholder prioritization workshops, as well as the RIF roundtable, Regional Issues Forum roundtable, where stakeholders sort of lead that effort in terms of thinking about prioritization and what's important to each of the RIF sectors. And then that process will be continuing sort of in its standard annual pace and steps as we did last year. So then in May, I will hear from stakeholders will be able to, individual basis, submit prioritization rankings on that, on those initiatives. Next slide, please. All right, and here we just have our swim lanes in terms of anticipated steps for how the year will go. And then I think we have one more of this for additional initiatives. Thank you, Brenda. And then I think that is it for me, unless there are any final questions.
Thank you, Becky. If anyone has a quick question, please raise your hand now. If not, we will go ahead and resume and go to lunch. But I don't see any questions at this time, Becky.
All right. Thanks so much.
Thank you, Becky. So the next topic will be resuming at 1 p.m. today. We plan to take a lunch break right now. As a reminder, we also have a meeting in the afternoon at 2 p.m. for the extended day ahead market to review the benefits methodology posted by Guillermo. So that will be at 2 p.m. So hopefully we end early with this meeting for those folks that are following us on the extended day ahead market. But at this time, we'll go ahead and take our lunch break, and we'll see you soon for release update in the afternoon. Thank you so much. Tegan, go ahead and close into practice session. Good afternoon, everyone. Welcome back to our Market Performance and Planning Forum. We are going to be doing the last few updates for the MPPF. As a reminder, this call is being recorded for informational convenience purposes only. Any related transcription should not be reprinted without the ISO's permission. We also have the transparency viewer available for those folks who want to see attendees who are logged into this meeting. As also a reminder to ask a question, use the raise hand located in the middle toolbar of your screen. If you are just dialed into the mobile device, you just use *3 and we'll be able to have you on the question queue. And then make sure when you have a question, please state your full name and affiliation. It will help us know who's speaking. And then also, I think that's the last reminder, I did provide a slide deck in the morning. At this time, that link is still the same one for this update for the release meeting that we will be sharing right now. And then on this morning, we did have both topics for market advanced analytics and policy update in the morning. So that will be showing on the recording that we plan to post within the next 3 to 5 business days on the Market Performance and Planning Forum webpage. And at this time, I would like to introduce Trang, who will be covering a few updates of her release management team. I want to make sure a quick audio check with Trang.
Hi, Brenda. Thank you.
Awesome. Go ahead. Ready for you.
All right. Okay, so we have a very condensed slide for the release update this time, just to quickly cover a few points and then also refer you to other meetings on the ISO side to have more detailed discussions. So this is our release overview, what's on the plan for this year. We have spring 2026. This is our focus right now with a lot of activities going on, and that includes DAME and then EDAM, ISO/BA participation rules, and then the EDAM onboarding of PacifiCorp. We also have the WEIM onboarding of PowerWatch and Black Hills Energy. For fall of this year, we'll have the EDAM onboarding of PGE, Portland General Electric. And then independent efforts that we have throughout 2026 are activities related to FERC 881 Track 2, FERC 881 Track 3, the continuation of transmission service and market scheduling priorities phase 2. We also have additional releases for the FERC Order 2023 generator interconnection life cycle, and then remaining items for subscriber PTO model, and then the continuation of transmission exchange agreement negotiation. So I have just high-level release timelines for the spring and fall 2026 releases, and for the independent items, I'm going to defer those to a future update to provide more details on. So we can go to the next slide for spring 2026. All right, so this is our two groups of implementations or onboardings for spring 2026. The first is the DAME and EDAM bundle, and then the below is WEIM onboarding. So for DAME, EDAM, ISO, BAA participation rules, those are all implementation efforts. And then we have the EDAM PAC onboarding. So those are all one package going together. And so these timelines apply to all of those going together. So we have market simulation for these efforts. That's in progress right now in map stage through the end of January. And I put a note that we also have the DAME configurable parameters analysis effort that we have a separate working group for that is leveraging data from market simulation. So that's noted there. And then we are focused right now on transitioning to parallel operations for this set of efforts. So that happens in the stage, the ISO stage environment, and we start that Monday, February 2nd, effective for trade date February 3rd, and that parallel operations will go through the end of April. And there's also a note that as part of the DAME configurable parameters analysis, we will determine values to be used for the stage parallel operations activity. And so we will determine the values for stage, we'll set those, and then we will continue to leverage parallel operations data for the DAME configurable parameters analysis effort. So that'll happen in that period through April 30th. And then we have the production activation of those implementations and onboarding for trade date May 1st of 2026. Okay. What we have also almost in parallel with the other activities is the WEIM onboarding of Power Watch and Black Hills Energy. Market simulation is in progress right now through the end of January for those onboarding entities for WEIM. Their parallel operations activities start in the stage environment for trade date February 18th. And then we have the production activation for WEIM onboarding entities on May 6, 2026. So we're staggering the start of parallel operations and the production activation for the WEIM entities just a little bit after the DAME and EDAM activities. Okay. So we can go to the next slide. All right, so for fall 2026, we have our EDAM onboarding of Portland General Electric. So the Portland is in market simulation and map stage now through the end of May of this year. And then that'll lead us into the parallel operations for Portland General Electric's EDAM onboarding. And that starts June 1st and will go through the middle of September this year, where we will then shift our focus to transition to the production activation for trade date October 1st. Okay. And then I think I just have one final slide, which is just the remaining independent efforts on the next slide. So we have various activities going on for these efforts that I went through in the release plan. So I won't go into detail now, but I will work to provide more updates later on. So our focus is on the spring and fall release activities, and then these ones are independent, so they may be completely isolated, like the generator interconnection life cycle is kind of isolated and doesn't have cross impacts, but some of the other efforts like FERC 881 or TSMSP to subscriber PTO and TEA have some shared impacts with DAME and EDAM in terms of market or settlements, and so we're coordinating these with those other activities without impacting the spring release. So one other thing I want to mention is that this is a very high level update, and usually I go into a little bit more detail in the release updates, but we do have various other forums to get more detailed information about the spring release that's happening right now and any future market sim or parallel operations activities. So every Monday and Thursday, Monday at 9 a.m. Pacific and then Thursday at 1 p.m. Pacific, we have a combined market simulation and parallel operations meeting that goes into detail for the execution of the market sim and parallel operations activities for those items mentioned before, so for the spring release and the fall release. And that's my quick update today. So Brenda, I'll hand it back over to you.
Thank you. We do have Shenyu who has a quick question. Go ahead, Shenyu. Please introduce yourself.
Sure. Thanks, Brenda. Good afternoon, Trang. This is Chun Yu from PG&E. Just a question on the release meeting. I know we used to have the release meeting, and also knowing that we have been so focused on the dam and EDAM, we've been just go to those two meetings. But seeing that on 2026, we do have quite a few initiatives, and if I'm not mistaken, I think we saw something else in the 2026 folder recently. I just wonder if CAISO, interested to have the release meeting at least once a month, so we will be on the same page as the implementation milestone. When shall we expecting the market sim, and when shall we expecting this release to go live?
Yeah, thank you so much for that feedback. And you're right, is that there are items that I didn't include in here, like for the data automation, the MMM data automation item that has a BRS out there and other things too. And so there are this isn't the complete picture either, but these are kind of the more significant items that I wanted to call out. So I like your proposal about making sure that we maintain and allow for focus on market simulation and parallel operations for spring release. And I think that's a good balance to have, to strive for, is having the release user group maybe once a month. So I will look and see when the next one could be. I don't think that it would be next Tuesday because we will be focused on starting parallel operations, but potentially a couple weeks after that, we could resume. So I'll continue to keep everyone posted in the twice weekly market sim and parallel operations calls on when to expect the next release user group. Okay.
Thank you, Trang. Yeah, I was also reviewing the calendar that Trang was just mentioning, where we can see where those dates are for those market sim meetings. And you'll see a lot of those meetings are highlighted. We do have a few settlement user groups already lined up, and also the technical user group. So I believe once Trang gets that added, it'll be showing up here as well. So you'll see it maybe in February, and it'll be highlighted on the California ISO monthly calendar as well, or in the notice as well. Okay, I don't see any other questions. I know we're also planning to do a customer partnership group in March, the second week of March, to review a little bit of the CRR process. So I know we mentioned that in the January 21st meeting. So that will also be has been added as tentatively for March 11th. I know a lot of folks were following us on that within the release user group as well. Just want to add that there with Trang's updates. But at this point, I don't think there's any other questions, Trang. We appreciate your help on providing high level here for our folks here today. Awesome. Just an update, we do have, we are really much ending pretty soon. Just one reminder, we do have the extended day ahead market benefits methodology today at 2 p.m. For those folks who are following us on that. That was posted last week, and that will kind of review a little bit of the methodology for that initiative. And then we are planning to do a tentative date for the April 29th, 2026 for the next forum. We did adjust the schedule in order to make sure we are able to capture data analysis provided by Guillermo's team, since they are pretty much providing a lot of information throughout most of the core meetings. So we appreciate everyone's feedback in the morning of providing, what kind of analysis they can look for. We also remind folks, if you do have questions or requests, city tickets are the most recommended pathway for submitting requests, whether questions or data requests. Just make sure you correctly label it in your subject, and also make sure you flag in the subject details what kind of request you're requesting, and also any needed exemption that you need for that specific request. At this time, I don't think there's any more questions. As a reference, we do plan to post within the next few days the Market Performance and Planning Forum recording. The slide deck is up to date with Trang's updates from this afternoon. If you have any questions, feel free to email me or ISO Stakeholder Affairs. We'll be ramping up, having more meetings for other meetings or for initiatives, but we also want to make sure for the next Market Performance and Planning Forum, if you have a specific topic that's out of the, maybe something we haven't shared, let us know. But we do our best in showing any out of the ordinary topics like the solar neighborhood that was announced in our notice and agenda. So folks were hopefully found something interesting for that topic that we presented this morning with Amber's team. But at this time, I think the last part I have is just that we did talk about a few PRs in the meeting. We just want a reminder that we do have the BPM library and webpage that have a lot of links, and it has been showing a lot of stuff for the folks who are following us. So there's a lot of definition acronyms that might have been mentioned throughout the meeting, but feel free to visit the CAISO website in case you are still stumbling on a few key acronyms within our meeting. And lastly, we do have the energy block matters that we have been showcasing. Recently, we just posted the stakeholder process guidelines, and that details the guidelines that we are currently working on within our stakeholder community and principal and core. So we wanted to share that as a blog a few weeks ago, as well update our new stakeholder process guide stakeholder initiative timeline. So that would be showcased in many of the initiatives that are in the working group phase or proposal development phase. And that would be something that my team and are working on as well. And at this time, the rest is appendix from Guillermo's team that I presented. Feel free to reference that at your own time. That is posted also on the Market Performance and Planning Forum. But at this time, thank you so much, everyone, for staying with us. We are planning to conclude this meeting a little early, so you guys have time to either join the 2 o'clock meeting happening today for the EDAM benefits methodology, or follow along with other meetings that will be happening later on. But we appreciate your participation, and we look forward to seeing you at the April 25th, 2026 meeting for MPPF. And I'll go ahead and pass it back to Tegan, my event producer.
That concludes our conference. Thank you for using Intel or events. You may now disconnect.